In this section, we'll be discussing exit strategies. In previous sections, we've discussed signal recognition and how to enter a trade with your online order software. How we enter a trade is one topic, but how we exit that trade is another. Exit strategies can vary depending upon the goals and objectives of the trader. This section will be devoted to the study of two exit strategies, both very different and both very effective for taking profits from the market. For quick in and out trades, there's the two-point exit strategy. This is where we enter a trade with any number of contracts and then exit on a limit order for the same number of contracts when price hits our two-point target objective. There's another effective strategy that you should master, and it's called the trailing stop strategy. From looking at the various charts, you've probably already noticed that the market often trends for extended periods. These trends can sometimes go for several hours and rise or fall for several points. The trailing stop exit strategy is designed to capture more of the profit potential that exists in the trend. This trailing stop strategy takes more time, but often the additional profits that it makes make it very worthwhile. First, let's go over the two-point exit strategy. Here's a chart showing a rather typical buy signal. The blue arrow points to our confirmation candle at 1403 on the timeline. We check the closing price of this candle that we will take as our hypothetical fill. And that would be 898.25. We will next set our two-point stop. And that will be at 896.25. We cannot overemphasize the importance of always setting your stop first. Once that is set, using our online order execution platform, we will then set our two-point profit target. We do that with a limit order entered at the price of 900.25. That's 2 points above our fill price. Now we wait, usually for just a few minutes, as price moves towards our profit target or towards our stop. In this example, price goes through our profit target. At 1423, the candle noted by the yellow arrow. This is a simple in and out strategy where we quickly can achieve our profit objective. We enter and exit with the same number of contracts, and we're flat in the market again in a relatively short time. This two-point exit strategy is very effective, and many students use it exclusively. Literal fortunes can be made simply by capturing one two-point move of the market daily. Other traders, however, look for those beautiful trends that often occur. They want to get in somewhere near the beginning and stay in for most of the duration of that trend. To do this, we will use what is called the trailing stop strategy. At 8:30 a.m. and 10:35 a.m. on our timeline of our chart. Let's assume that we entered the market on the buy signal at the time of about 8:43. The blue arrow shows our entry candle with a fill price of 892. For this example, we'll use two contracts. Actually, for the trailing stop method, you can use any number of contracts that you wish, but that number should be some multiple of 2, and of course would depend upon the size of the margin in your account. You'll want to exit half your contracts quickly and then let the other half run with a trailing stop. Just as with our two-point exit strategy, we will set a two-point stop in order to protect this trade. This stop will be for the same number of contracts that we entered with. Our profit target, however, will be for 2 points, but it will only be for half the number of the contracts we entered with. So for this example, we reach our 2-point profit objective of 894 at about 8:47 a.m. on our timeline. And when price hits our limit order, we take our 2-point profit with one contract. Our other contract, however, still remains, and if the trend continues, we may be able to capture considerable extra profits. When price hits our 2-point objective and half of our contracts are filled, we will immediately move our stop. The stop should be moved to break even, or even one tick better than break even, so that our commissions will be covered in case price now goes against us. Well, that way, none of the profit that we've already achieved will be jeopardized. With our stop moved, we simply wait for price to continue in the trend direction with its characteristic higher highs and higher lows, that stair-step formation. We will now use the DS to tell us when to move our stop. Whenever the DS hooks down and price produces a down candle and we've made some profit, we will then move our stop. Notice here that at about 9:03 a.m., the DS hooks down and we see the red candle. It's time to move our stop. The best place to move the stop is 1/2 point below the last pullback in price. This is also known as where price hits support. The blue arrow shows our approximate new stop location. And now we wait for the DS to cycle again, hook down, and produce another red candle. It does that at about 9:22 a.m. You should move your stop to 1/2 point below that minor pullback low that's indicated by the blue arrow. Just looking at price, we may have missed that this low existed, but the DS confirms that it's there. Now we wait for the next cycle of the DS. Here, at about 9:42 a.m., the DS hooks down and we get another red candle. It's time to move our stop. It goes to 1/2 point below that area of overall congestion that we see at about 9:25 a.m. Here, the DS has cycled again, but we really haven't made any profit to speak of, so we suggest that you leave your stop alone and don't move it. Now, at about 10:08 a.m., the DS hooks with a red bar, and since we have made some profit, we will now move our stop. The best location is 1/2 point below the pullback low at about 9:55 a.m. on the timeline. And now we wait again. During the next cycle of the DS, price goes sideways, basically producing no profit, so once again we will leave our stop where it is. The next cycle of the DS does produce a red candle, and we've made a little profit, so we will once again move our stop. It will sit 1/2 point below the congested sideways movement of price in that 10:20 a.m. area on the timeline. Well, so far we've made 2 points on our first contract, and we've made about 11¼ points on our second contract. And we'll continue watching the DS, and each time it hooks with a red candle, making some profit, we will move our stop again, capturing more and more profit if the trend continues. At some point, price will turn against us and we'll hit our stop, but because that stop is there, we will only lose a small fraction of the profits that we've already captured. We will also be watching for signals to reverse, and we will reverse if we get a valid and takeable signal to do so. Well, this has been an example of an uptrend trailing stop exit strategy, and the same works for a downtrend also. Only with the downtrend, we'll be moving our stop downward whenever the DS hooks up with an up-colored candle. The trailing stop strategy is excellent for capturing the extra profit potential of trends, and those extra points that they can produce really help fill the gaps from other trades that we take that get stopped out. The trailing stop exit strategy takes considerable more time and focus and patience than the 2-point exit strategy, but it is worth the extra effort required to master it. Our suggestion is to start with the 2-point exit strategy, and once you've mastered that, then you can progress to the trailing stop exit strategy. Well, this concludes section 10 of our training, and if any part of this section was not totally clear to you, then we suggest that you review the section again. And if any questions still remain, be sure and write them down, and we'll go over those questions in the online portion of your training. If you've thoroughly understood this section, then you can proceed to section 11.